The Scandalous American International Group, with the acronym AIG, presented by Devin Dockery. The agenda of this presentation includes a background of AIG, the individuals involved in the fraud of 2005, what actually happened, how they got caught, what the outcome of the fraud was, and where AIG is now, with a bibliography at the end citing my sources. Going into the history of AIG, it is a global insurance company that operates in more than 80 countries and jurisdictions and provides life insurance and retirement services for commercial, institutional, and individual customers. It was founded in 1919 by an American, Cornelius Vanderstar, in Shanghai, China. In 1926, it opened up its first U.S. office in New York City, New York. In 1968, Maurice Greenberg succeeds Cornelius Vanderstar as company leader. In 1984, AIG stocks went public on the New York Stock Exchange in hopes of, that's right, you guessed it, more global expansion. In 2005, Maurice Greenberg retired and Martin Sullivan took his place as CEO. Also in 2005, and the reason for this presentation, a fraud investigation was conducted by the Securities and Exchange Commission, which a year later in 2006 led to a $1.64 billion settlement. In 2008, AIG became known as one of the largest governmental bailouts in the 2008 financial crisis, with a $182 billion bailout. You see, AIG was so large globally that its demise would impact the entire global economy. Thus, the government had to step in. As a result of the financial crisis, AIG started cutting costs, employees, and executive leaders, as well as selling its assets to become more profitable again. In 2017, the federal government ended its oversight of AIG and designated AIG to be quote-unquote too big to fail. Also in 2017, Brian Duperrault was appointed CEO and is currently the CEO of AIG. Now, the accounting scandal you've all been waiting for happened from late 2000 to 2005. It was a result between two companies, the American International Group known as AIG and the general reinsurance company known as Gen Re. And just to throw in a little background of what Gen Re is, it is a multinational American property, casualty, life, and health reinsurance company that offers a wide range of reinsurance products and services. With that said, let's look into which individuals were involved. There were two key players, Maurice Greenberg, also referred to as Hank Greenberg, and Ronald Ferguson. The picture on the left of the screen is Maurice Greenberg. He joined AIG in 1962 and was named CEO in 1968. He led AIG for 38 years when he coincidentally stepped down in 2005. The picture on the right of the screen is Ronald Ferguson. He joined Gen Re in 1966 and became CEO in 1987. He retired from Gen Re in 2002. The other individuals involved were Christian Milton, the Vice President of AIG's Reinsurance, Elizabeth Monrad, the Chief Financial Officer of Gen Re, Robert Graham, the Senior Vice President and Assistant General Counsel employed by Gen Re, Christopher Garand, the Senior Vice President and Chief Underwriter of Gen Re's finite reinsurance operations, and Howard Smith, the Chief Financial Officer of AIG. So, what actually happened between AIG and Gen Re? Well, from late 2000 to 2005, AIG created faulty financial statements in an attempt to conceal losses and deceive analysts and investors to thinking that the company had exceptional financial results. You see, in October of 2000, AIG announced an increase in premiums with a decrease in their loss reserves by $59 million, which was followed by a drop of 6% in their stock. And according to investigators, AIG's reserves were too low to support such results. Additionally, there is a direct relationship between premiums and loss reserves, so if one increases, the other should too, which was obviously not the case for AIG. Therefore, this indicated a big cash flow problem. And in order to help boost AIG's loss reserves, top executives of AIG sought help from the general reinsurance company to use improper accounting. The general reinsurance company, also known as Gen Re, agreed to pay $500 million in reinsurance premiums in return for AIG's reinsuring a $500 million risk. The transaction had no economic substance but was designed to look like a general reinsurance with a risk transfer in order to achieve the accounting effect. The only economic benefit to either party was a $500 million fee paid by AIG to Gen Re for putting the deal together, which was actually more like a hush-hush side deal. Since there was no actual risk transferred, the transaction was not an insurance deal, which means the $500 million should not be categorized as income. However, AIG accounted for the transaction as a normal reinsurance deal, which inflated their financials and thus showed a more favorable view of AIG's underwriting performance. In addition to January's assistance in inflating the loss of revenues of AIG also recorded loans as revenues, participated in bid rigging, sold bonds within the company, and converted losses into capital in order to make it appear as though AIG was well off financially. By now, you're probably thinking, why didn't the external auditors catch anything? That brings us to the attention of the questionable independence of AIG's external auditor, PricewaterhouseCoopers, also known as PwC. Prior to the 2005 scandal, PwC was the auditor of AIG for over 2 decades. What's more is the former CFO of AIG at the time was Howard Smith, and he worked for Coopers and LeBrandt for 19 years before he went to AIG. You see, Coopers and LeBrandt merged with Pricewaterhouse into what we know today as PricewaterhouseCoopers, so already right there, there's a conflict. Additionally, AIG was one of PwC's biggest clients, paying them about $140 million for their services between 2000 and 2003. Therefore, the objectivity and reliability of PwC was for the most part non-existent. But one thing is for certain, if PwC would have gone through strict auditing procedures, the accounting scandal committed by AIG would have been discovered much sooner without the involvement of regulators. This then leads to the question of, how did AIG get caught? Well, in 2004, the Attorney General's office and the Insurance Department began investigating the insurance industry for ongoing misconduct. During the routine investigation, they found AIG and four other insurers guilty of bid rigging. In essence, they were cheating their customers by rigging their prices and steering business to insurers in exchange for millions of dollars in kickbacks. And in early 2005, the SEC began jointly investigating a series of allegedly fraudulent transactions by AIG, which included the January transactions and all the other efforts they tried to inflate their reserves in order to mislead investors, which led to AIG getting sued. As a result of the fraud, AIG agreed to adopt a series of reforms and pay back $1.64 billion in restitution and penalties. AIG CEO at the time, Maurice Greenberg, was sued against the state of New York and had to pay $15 million, while former AIG CFO Howard Smith was to pay $1.5 million. However, Greenberg denied any wrongdoing, that is, until 12 years later in 2017, when at 91 years old, he finally acknowledged that he and Howard Smith participated and approved the claims against them. Thus, the prior conviction was lessened, and Maurice had to pay $900 million to the state of New York, and Howard had to pay $9 million. Maurice Greenberg also had to pay $115 million to AIG shareholders for his deceiving act. In addition, General Reinsurance Company agreed to pay $92.2 million to settle its allegations, and the four Gen Re executives were found guilty on charges with conspiracy, securities fraud, false statements to the SEC, and mail fraud, each receiving fines ranging from $100,000 to $250,000 once their prison sentences were overturned in 2011. After paying all of its debts from the 2005 scandal and the 2008 governmental bailout, AIG has clawed its way back from the depths of financial despair and is finally starting to make deals again. In fact, just last year in 2018, AIG acquired a Bermuda reinsurer, Validus Holdings, for $5.56 billion in an all-cash transaction. Thus, CEO Brian Duperrault has made no secret of his plans in wanting to set the standards within the industry by focusing on the growth of AIG. And this concludes my presentation. Thank you.